Have you ever wondered what inflation really means? Let's unravel this economic term together. Picture this. You're at your local grocery store and you've just picked up your usual loaf of bread and gallon of milk. But when you reach the checkout, you realize you're paying more than you did last year for the exact same items. This, my friends, is inflation in action. Inflation, in its simplest form, is the general increase in prices over time, reducing the purchasing power of money. It's not limited to just your grocery shopping. Think about the cost of a movie ticket, a cup of coffee, or even a house. If you've noticed these things getting pricier year after year, that's inflation. Inflation is an invisible force that slowly but surely erodes the buying power of your money. It's why the dollar in your pocket today might not stretch as far tomorrow. In simple terms, inflation is why your dollar today might not buy as much as it did last year. Ever heard of the Consumer Price Index, or CPI? It's a key tool used by economists to measure inflation. Picture this. The CPI is like a shopping basket, but instead of groceries, this basket contains a mix of goods and services that the average household might buy. We're talking about everyday items like bread, milk, clothing, transportation costs, even medical care. Here's how it works. The CPI tracks the changes in the prices of these items over time. Say the cost of this hypothetical basket was $100 last year. This year, if it costs you $102 to buy the exact same items, that's a 2% increase. That's inflation. It's important to note that the CPI doesn't track the price of every single item in the economy. Rather, it's a representative sample. So the CPI helps us track how much more we're paying for the same things over time. Did you know there are different types of inflation? Let's start with demand pull inflation. Picture this. A popular new gadget hits the market. It's in such high demand that the manufacturer can't keep up. So what happens? The price goes up. That's demand pull inflation in action. Then we have cost push inflation. Imagine the price of oil suddenly shoots up. This increases the cost of production for anything that uses oil, which is pretty much everything. As a result, the prices of goods and services rise. That's cost push inflation for you. Finally, we have built-in inflation. This one's a bit different. It's based on people's expectation of rising prices. If everyone expects prices to go up, they'll demand higher wages. And businesses, in turn, will increase their prices to cover these wages. It's a self-fulfilling prophecy. So, not all inflation is created equal. Ever wondered what causes inflation? Let's delve into that. At its core, inflation is fueled by three main factors: increased demand, rising production costs, and expansionary monetary policy. Picture a bustling economy. More jobs, more disposable income, more spending. This surge in demand can lead to businesses raising their prices, triggering inflation. That's demand pull inflation for you. Then we have rising production costs. Think higher wages or more expensive raw materials. These costs seep into the price tags of products and services, pushing up inflation. This is referred to as cost push inflation. Lastly, there's expansionary monetary policy. When a central bank pumps more money into the economy, be it through lower interest rates or buying government bonds, it can lead to too much money chasing too few goods and services, a classic recipe for inflation. Inflation, in a nutshell, is a byproduct of a growing economy. But what does inflation mean for you and me? Well, there are a few effects to consider. Firstly, inflation reduces purchasing power. If you've ever heard your grandparents say, "Back in my day, a dollar could buy so much more," they're essentially talking about the reduction in purchasing power over time due to inflation. Another effect is decreased real wages. Let's say you earn a fixed salary of $50,000 a year. As inflation rises, the value of that $50,000 decreases. This means you can buy less with the same amount of money. For example, if the price of groceries goes up by 3%, but your salary stays the same, you're essentially taking a pay cut. So in essence, inflation means that your money doesn't stretch as far as it used to. It's like trying to cover a queen-sized bed with a twin-sized blanket. Inflation can indeed make life more expensive. Ever heard of a situation worse than inflation? It's called hyperinflation. Picture this: inflation on steroids. That's hyperinflation for you. It's an extreme form of inflation characterized by rapid and excessive increases in prices. We're talking about prices doubling, tripling, or even quadrupling in a very short time. Take Zimbabwe or Venezuela, for instance. At one point in Zimbabwe, prices were doubling every 24 hours. Imagine waking up to find that the price of bread has doubled overnight. Or in Venezuela, where inflation reached an astronomical 1,000,000% in 2018. People were literally carrying bags of cash just to buy a loaf of bread. The effects? Well, they're catastrophic. Savings become worthless, the currency loses its value, and economic instability is rampant. It's an economic nightmare that often leads to social and political upheaval. Hyperinflation, as you can see, can be disastrous for any economy. It's a beast that no country ever wants to face. So how do we keep track of inflation? Well, it's all about using certain tools that economists have developed, specifically indices like the Consumer Price Index, or CPI, and the Producer Price Index, or PPI. The CPI is a measure that examines the weighted average of prices of a basket of consumer goods and services, like transportation, food, and medical care. It's calculated by taking price changes for each item in this predetermined basket and averaging them. On the other hand, the PPI is a family of indices that gauges the average fluctuation in selling prices received by domestic producers for their output. It gives us insights into the trends of wholesale markets, manufacturing industries, and commodities. So, whether it's the CPI tracking what we as consumers pay for our goods and services, or the PPI giving us a glimpse into the selling prices for producers, these indices help us keep a finger on the pulse of our economy. So, how fast are prices really rising? That's where the inflation rate comes in. The inflation rate is a key economic indicator, and it's essentially the percentage change in the price level over a specific period. This is usually calculated on an annual basis. Here's an easy way to understand it. Let's say you bought a loaf of bread for $3 last year, and this year, the same loaf costs $3.30. The inflation rate in this case would be 10% because the price has increased by 10% from the previous year. It's important to note that the inflation rate is not constant. It fluctuates due to various factors such as changes in supply and demand, government policies, and global economic trends. Economists and policymakers keep a close eye on the inflation rate because it helps them make decisions about interest rates, taxation, and government spending. But what if prices fall instead of rise? That's called deflation. Deflation is the economic condition where the overall price of goods and services is decreasing. Sounds good, right? Well, not so fast. It's tempting to think that cheaper prices are a win for consumers, but deflation can actually signal trouble in the economy. For instance, when prices fall, businesses earn less for their products and services, which might cause them to cut costs by laying off workers or reducing wages. This can lead to a vicious cycle. As people's incomes decrease, they tend to spend less, causing prices to drop even further. Moreover, deflation can increase the real value of debt, making it harder for people and businesses to pay off their loans. And just like inflation, deflation can create uncertainty in the financial markets, making investors less likely to put their money at risk. As you can see, falling prices can be just as problematic as rising ones. Ever been caught in a loop? The wage price spiral is a similar concept. It's an economic phenomenon wherein rising wages lead to higher prices, which in turn lead to further demands for wage increases. Let me break it down. Imagine you're an employer. To attract talent and keep your employees happy, you raise their wages. Now, your employees have more money to spend and they start buying more. The increased demand for goods and services can cause prices to go up. This is basic supply and demand. But here's where the spiral starts. As prices rise, your employees find that their increased wages don't stretch as far as they used to. So they ask for another wage increase. If you grant it, the cycle starts all over again. This wage price spiral can contribute to ongoing inflation. If not properly managed, it can lead to a situation where rising wages and prices chase each other in an ongoing loop. In a wage price spiral, rising wages and prices chase each other in an ongoing loop. So let's take a moment to recap what we've learned about inflation. We started with the basics, defining inflation as a general increase in prices of goods and services over time. We then delved into the Consumer Price Index, a handy tool that tracks these price changes. We explored the types of inflation: demand pull, cost push, and built-in, each with its unique triggers and effects. We also discussed the various factors that contribute to inflation, from increased demand and rising production costs to expansionary monetary policy. We looked at the economic effects of inflation, such as reduced purchasing power and uncertainty in financial markets. We also touched on the extreme form of inflation known as hyperinflation and its potential for economic instability. We learned how inflation is measured using indices like the CPI and the Producer Price Index. We debated the concept of deflation, and finally, we unraveled the wage price spiral, where rising wages lead to higher prices, perpetuating a cycle of inflation. Inflation might seem complex, but understanding it can help us make sense of our economy and our financial lives.